Yeah, welcome for joining us here. We've got a lot to cover this evening, and hopefully we'll have a lot of fun and cover some very educational things for you all.
We did notice there's been a few questions that have come in already. We'll be answering those later in the broadcast, but go ahead if you have any questions during the session. We won't be able to monitor them directly that easily while we're presenting, but we will try and get to all your questions before the end of the evening. So speaking of what we're going to be presenting this evening, the purpose of tonight is to give you more education on all the different ways you can be making money right now with the software, and to also show you what we've been trading here recently to actually also to encourage you to be using the software as well.
Okay, so tonight we're going to cover, first of all, the Netflix trade. Now, we talked about that in the email that we sent out. It was a killer trade early this week, and then we'll talk about other current trades. We're going to show you some of the best current seasonal stocks that are out there, some of the best current growth stocks. We're going to talk about high consistency trading stocks and high risk-reward ratio trading with spreads.
Very cool.
Okay, so starting off, unfortunately we cannot get the phone calls coming in here. Well, maybe Bret can take it while I'll run the presentation here.
Go ahead.
Okay. Well, what do we know about Netflix before the earnings announcement? All right. Well, starting off with this is a long-term chart of Netflix, and we can see back in 2010, Netflix had a big run. Well, what was the stock doing back then? Netflix is a company that, as you might know, has online movies that you can select, and for $8 a month, you had a whole collection. A selection of different movies that you could watch. And then, so they made a lot of money, but then look what happened right after that. We see that we had a big drop. Well, what happened? Why did the stock drop? Well, they decided that instead of $8 a month to see whatever you want, they changed it to pay-per-view. And people didn't like that. It was not a good idea. Well, they realized their mistake, and then what happened? Back to plan A, and we see, click it again. The stock took off, and that's where we are today, back on track. So when we see these big swings, the point of what I'm getting at, when we see these big swings in stocks, there's reasons behind it. We always don't know that, but that's what causes this up and down action. Now, when this is the seasonal chart on Netflix. Now, this is something that Bret and I developed about 10 years ago. We're working on this, and notice over there in January that we see that the earnings, those little green dots, the earnings comes out, and the stock has a big move to the upside. So if we drag our mouse, we can see that this stock has gone up 11 out of 11 years, and on the average, it's risen 20% at this time of year. So if we're looking to take a trade on Netflix, we know that the stock, just prior to the earnings announcement, was $348. So if it's a $348 stock and we're expecting a 20% move, that's a $68 move. Now, the chart shows us the green dots. We're expecting earnings, and I can go to my Thinkorswim trading platform, and that will tell me the exact day. So I know that ahead of time. So in this case, we knew that the earnings were going to be announced after the market closed on January 20th, 2015. Now, here we can see what happened, where obviously we had to get our orders in on the 20th before the market closed. But once the earnings were announced a little bit after 4 p.m. on the 20th, the stock had a big jump in the after-hours market, and we can see the next day it had jumped $60 overnight. And you could see how we estimated this move ahead of time. We estimated a $68 move, and we had a $60 move. That's pretty gosh darn close. Okay, so here was what the stock looked like. If on your trading platforms, this is what it looked like on my screens, Thinkorswim, on January 20th, before the earnings were announced. The stock closed that day at 348, and if you look at towards the top there, the at the money would be the 347.50. The calls were selling for about $20, and the puts were also selling for about $20. That's a pretty expensive premium. That means each call, an at-the-money call, would be costing you $2,000. Very expensive calls. Now, here's what happened a day or two later. I couldn't get the exact next day, but this is I got this morning when I was doing the charts, and we can see that the 347 option is now $80. So it went from 20 to 80. That's a big jump. Now, what I've done is made a spreadsheet to show you on these options, because we have to make a decision. Which options are we going to buy? We know the stock is going to have a big move by looking at the seasonals. What are we going to trade? So let's take a look at, this is a spreadsheet showing you, starting at the top, on January 20th, the stock was 348, and on the 22nd, it was 428. That's a two-day move, which was $79, which would give you a 23% return in 2 days. I mean, that's killer.
On the stock.
Just on buying and selling the stock. But look at the return on the options. The first one, the 347, now I put in the ask because the bid was $20. But if you're going to buy it, you're going to have to pay the ask. If you want to sell it, you'll get the bid. You can try and negotiate in between, but basically, if you put your order into the ask, you will probably get it, and and so forth. So we can see that from $22.80 up to $80, that's a $57 move, or a 252%. That's what we call a 2.5 bagger, where you 2.5 times your money virtually overnight. Now, if we look down below, we can see, like the 290 option, you would have 6 times your money, going from $4.90 up to $38. I mean, that's a huge move.
390. Sorry.
Excuse me. Yeah. So obviously, we can see the further we go out on the options, they become cheaper. We have a higher percent return, but we have a higher risk. I mean, if the stock doesn't make it to that level, then the options expire worthless. So we have to weigh what are we expecting the stock to move. This is why best choice is so critical, knowing that 20% move and calculating approximately what we would expect.
You mean we have to be right about the stock?
Well, it helps.
I know that's what you always say. I mean, you're right. You have to be. I mean, you can know every option strategy, strangles, straddles. You can know iron condors. But if you're not right about the stock, it doesn't matter. You have to be first right about the stock before you apply the proper strategy.
And you have to know when is it going to move. What is going to cause it to move? Okay, so now you could just simply buy a call or buy a put. But a vertical spread is another alternative. A lot of advanced traders like this because it has a number of benefits. Now, vertical spread just means that you're buying one call and selling another. Let's say you bought the 360 and sold the 370. Well, you got the right to buy it at 360. Okay, if it goes up to 370, well, you bought it at 360, you sold it at 370. You made $10. It's simple as that. So vertical spreads allow you to reduce your cost basis, and I'll explain this in a minute, many times by 50% or more. It avoids a volatility crush, I'll explain that as well, and vastly increases your risk-reward ratio. Like, let me show you. For example, on our Netflix trade, say you bought the 360, which would cost you $15.50, and sold the 370, which you're getting back $11.50. So if you're paying $15.50 and you get back $11.50, your cost is $4.
And that's a lot less, or a lot more than 50% reduction there. If you consider a $15 cost and then you're reducing it by over 11, that's much more than 50% of a cost reduction.
Right. So it's a whole lot cheaper than buying the outright call. So that's the first advantage of a vertical spread. Let's look at the now. You see, you can calculate the maximum profit and maximum loss on the spread. It's very easy. In other words, the maximum difference between those two spreads is $10. So the risk is what you spent, which is the $4, and the maximum profit is always going to be $6. You see that what your cost plus your profit adds creates the difference between the 360 and the 370. Now, let's say on the Netflix trade that we just talked about had a massive move earlier this week, and I mean Bret and I were just ecstatic because we more than doubled and tripled our money on it, to be honest with you. If it didn't happen, those huge premiums are going to drop on you. That's what they call volatility crush. Because what happens before the earnings are announced, there's a lot of uncertainty. People don't know what is going to happen. Like I showed you earlier, the call prices are $20, the put prices are $20. Now you could do buy a put and a call is going to cost you $40, which means you've got to have a much bigger move, but one of those options is going to be a loser. So in this case, we already have a direction picked out. There's no need to do that. So, but if it didn't work, you're going to lose. The premiums are going to collapse because once the earnings are announced, there's no more mystery. And so that's why we have a volatility crush on every earnings report. So you lose your spread, but in the case you lose your premium, but in the case of a spread, you're only going to lose the $4, not $15. So your risk is less. Now, like I mentioned earlier, your maximum profit on the spread is the $6 if the stock closes above the 370, and you multiplied your money 150%. And you knew exactly ahead of time what your maximum profit was. You don't know that when you're buying buying a call or a put.
The big argument often seems to be, well, I could have made more money on straight calls than spreads. Like, for example, Gary's group, he was recommending to his group to do the 390 calls, and they actually made a 400% return on those calls. They did very well. In fact, they even did better than I did on my spreads, but that's because I didn't do my spreads as far out at the 390s like they did. If I would have done my spreads at the 390 strike like they did, I actually would have made a bigger percentage return than they did. So the only time a straight call or a straight put will outperform a spread is if the stock ends up doing vastly farther than what you expected. But as you noticed up here, like we were mentioning, the fact that most of the time the stock does not go vastly farther than you expected. Most of the time the stocks are making little moves here and there, bouncing around. And so most of the time, if you're doing a spread and you're reducing your cost basis by more than 50%, you're going to make more money over the long run versus doing more of the home run type trades with straight calls and puts. And that's why we try and talk so much to people about spreads. And if you're not really familiar with options or spreads, tonight we're not really trying to explain all the details about spreads and give you everything about them. We just want to encourage you guys, if you don't understand spreads, to learn about them because they can vastly increase your risk-reward ratio, which is what I'm getting ready to talk about on the next slide. We mentioned that vertical spreads allow you to increase your risk-to-reward ratio. And for those of you guys that aren't really familiar with that, the better your risk-to-reward ratio, the more profit you will make when you are right, and the less you will lose when you are wrong. People was talking about that volatility crush. If Netflix had only, say, moved half of the amount that it actually moved, say it moved $30 instead of $60, which can happen sometimes, the people that held those 390 calls would have had a pretty good sized loss because it didn't move far enough to go up to their strikes. Where if I had a spread on, my losses would be much less. Again, when you're wrong, and that's the whole key to being profitable when you're trading. When you're right, you want to get your maximum profit that you can when you're right, but when you're wrong, you want to take as small of a loss as you possibly can. And so as an example here, this is what I had mentioned in our email to you guys about the risk-reward ratios and how spreads can just do some really amazing things that I don't think a lot of people understand. And so for this example, if you were placing in this example, we're not expecting in this example a big move. This is just the general week-to-week volatility. Stocks bouncing around. They'll move up a little bit. They'll move down a little bit. Not too much. Most stocks don't move more than maybe a couple % a week at the most. But if you were placing an at-the-money vertical spread, like Pete was talking about earlier, the at-the-money spread, where you're buying one strike in the money in this case, but selling one strike out of the money, okay, obviously at this point your cost will always be near the middle of the strikes. In this example, this is kind of a specific example where I'm buying one in the money, and kind of visualize that in your mind for those of you guys that know what in the money means. And then we're selling one strike out of the money. That means that the price of the stock is somewhere in between these strikes. And so in this example here, and I'm giving this specific example for a specific reason. Okay, for in this example, we had $5 difference in those strikes. That means the stock would be somewhere about $2.50 in between those strikes. And so in this case, when you put on a spread like this, where you're kind of straddling the current stock price, where you're buying one strike in the money and you're selling the one that's out of the money, one strike out of the money, your cost will always be in the about in the middle of the difference of those strikes. So in this case, if you're doing a $5 spread, your cost will always be near $2.50, or obviously you have to multiply that by 100. So one contract on that spread would be about $250. But if your cost is $250 on a $5 difference in strikes, that means your profit, your max profit, will also be the difference in strikes, which is that $250. So that would give us, as long as the stock moves above that short strike, our max profit is 100%. If our max risk is $250, but our max profit is $250, that means that's going to be a 100% return. But that 100% return is on a very small move in the stock, usually less than 2%. And one example I just wanted to show you real quick was in Google this week. And this is a good example, too, of volatility and differences between spreads and calls. Let me bring up Best Choice here, and we got Netflix up here. But let me pull up Google. Okay, you can see here we had a nice kind of a, and again, I was kind of looking intraday also, but we broke out above the last 4 or 5 days to the upside. And so if you notice the prices over here, I did a near the money or pretty close to the money spread. By the time I got in, Google was around $513, $512, somewhere around here. And so I bought the 510 call and I sold the 515 call, basically kind of straddling the current price of the stock. And as long as Google got above 515 by the expiration, which my expiration was actually today on this trade, so in about a week, actually less than a week technically, so I think I put this trade on Monday. My main point is here, the stock doesn't have to move that, let me unclick that. The stock doesn't have to move that far for me to make a 100% return. And yet usually I use myself a 2-day trailing stop behind prices. If the stock had turned around and I'd gotten stopped out, typically it's going to be somewhere around here, I'm not losing more than 50% of that trade, of that spread cost. But every time I'm right, I'm making 100%, again, on a very small move in the stock. Now, in this case, of course, Google did move up a lot. In fact, it moved up huge versus the market this week. But in this case, yes, a long call would have made more money than my spread, but does Google normally make these huge moves? It has here recently because we've had a lot of volatility in the market. Let me pull up 1 year. But typically, it's just kind of bouncing around. Every now and then, you'll get a big move here. Like here, you got some big move here, but most of the time it's just kind of bouncing around, and that's what we will kind of want to use the example of this in explaining how spreads can increase your consistency in your trading, because most of the time the stock isn't making these huge moves. It's just bouncing around a little bit here, a little bit there, and so you can increase your consistency in your trading by taking advantage of what the stock does most of the time. And that's one thing that really excites me about these spreads also is I can make a 100% return on a very small move in the stock because of that spread, where, as you guys know, if you're holding a long call and the stock's not doing that much, most of the time you're losing value on those long calls because of the time decay. Where on a spread, because I've sold a strike also against my long strike, it's offsetting the time value loss of my long strike. So we didn't want to spend too much time on this, but we just, like I said, we want to show you guys some of these things that we're doing to encourage you, those of you that don't understand these things, to definitely, maybe get with Gary and his group because he teaches this kind of stuff. But learn this stuff because you can be making money every month with these techniques if you're not doing so already. So let's go ahead and get back to our PowerPoint slide, get back on track. I know I chased a rabbit trail or two there. So we did want to mention some of the upcoming seasonal trades. We mentioned in our email that we're going to give you guys some of the upcoming trades. Priceline is probably one of the bigger trades that's coming up. Let me just pull up Priceline real quick. We do have a lot of information we're going to try and give you guys tonight. This will be recorded for those of you guys, if you guys have asked if tonight's going to be recorded, we are recording this right now. So you'll be able to go back through this and kind of absorb and listen again to a lot of the stuff in case you miss anything. But you can see here coming up in February, we got a big move in price line. And this one, I believe also, let me see what my settings are here real quick. I should probably do the best rating of the whole zone. You can see, is that right?
9 out of 10.
Is it 9 out of 10? I was thinking price line was 100%. I guess I was wrong. Let's click on here. I don't get that. 2011. It must have been just right where that was. That doesn't seem right to me. Let me double check here and click on January and then highlight it over here in case there's something with that, because
no.
This should be a 100% trade. It looks like we may have a bug here that we have missed here recently because, oh, you know what it was? I know what it was. When you're viewing a stock, somewhere in the middle of the year, starting where July's over here, because you can set up this however you want. If you want to start, viewing the chart from July or different points of the year, we mainly did this to make it easier to see what things look like between December and January. So if I click on January here, and I've got 2011 highlighted here. Let's go ahead and highlight this again. And I apologize. This is kind of a technical thing. But if I highlight 2011, you can see actually we got in right here, and then when we get out, the stock had actually pulled back already on these particular dates. But if you look at the individual dates, and let's do this because this is a really good teaching technique that I want to show you, because seasonal trading, okay, if you look at this highlight, the length of this trade here is 14 days. This is not representative of the actual overnight earnings trade. And so you want to make sure that you understand that. If I go to 2011 here on Priceline, and I do this on these overnight earnings trades, I go to every year and look and see exactly what happened on the overnight, because it's not so easy to see on the seasonal chart what happened on the actual overnight trade. So let's come back here to the beginning of 2011. And so you can see here in February, we actually did on the overnight, we had a big gap up. So you want to make sure you understand the difference there between the overnight move and the seasonal 2-week move that is on the seasonal trading charts. So the actual overnight move is 100% on Priceline. It's just what happened was, if you notice here on the seasonal charts, and if I highlight this again, you'll see it. All right, these dates here are not the exact dates every year. We have these listed as the average start and the average end because it doesn't always start on the exact day every year. It can happen, the move can break out up to a week before these dates or up to a week after, because if you highlight these different years, you'll see, okay, well, this one actually started pretty close to the start date if I highlight 2014. If I highlight like 2013, well, it didn't quite start exactly on that day. You can see on these highlighted lines, which are the charts for the years that you're selecting, okay, they don't always start exactly on the same date. The best that the computer can do is give you the best start date. So anyway, without going too much into that, Priceline is 100% over the last 10 or 11 years as far as the overnight move. And so I just wanted to make sure you guys understood that. And that is coming up here in the middle of February pretty quickly. And we definitely don't want you guys to miss out like on some of the people that had missed out on the Netflix trade here recently. Did you have something you want to mention,
No,
Pete?
no, good.
Okay, all right. Yeah, let's just I know we could probably spend 3 days talking about a lot of this stuff. It's hard to kind of jam pack this into one 1 or 2 hour webinar. But we also wanted to mention too, we have a slide at the end of the presentation that's going to give you all 10 of those stocks that we mentioned in the email that have had 100% winners over the last 10 years that may have made a minimum of 8% moves, but we'll be giving you those symbols here at the end of the presentation. So we didn't want to spend all the time going through all those because we have so much else left to present. But we did want to mention too that seasonal trades are really only one of the 3 main trading methods in Best Choice. There's 2 other trading methods that we teach also in Best Choice. And so we wanted to spend a little time tonight also going through some of those. So I wanted to mention here real quick, because I know in previous webinars we talk about Christopher Cross and the amazing thing he did one year where he took a $6,500 account and turned it into $1.6 million, basically just over 6 seasonal trades. But I want to make sure that you guys understand that it's, what he did was pretty spectacular, but it's not that repeatable. He basically won 6 trades in a row, and he put, his whole account, which was a small account, and it was only one of his accounts. He had other money, so it wasn't a whole lot to him to lose. But he took his whole $6,500 account and put most of that on the first trade. He won that trade and made like 3 or 4 times his money, and just kept doing it. And all of a sudden, he's got $1.6 million. Well, if you think about what risk management, tells us, that's not really the way you want to try and trade, because all it would have taken is one of those trades to lose, and he would have lost that whole account. So what is more important, saying you took a $6,500 account to $1.6 million, or just making $1.6 million no matter where you start from? Okay, obviously we heartily do not recommend putting large amounts of your account on any one trade. But let's say if you had a $65,000 account and you took 10 seasonal trades that normally move more than 10% throughout the year, like some of these bigger trades like Google and Priceline and Netflix, okay, and you split your account up and only use 10% of your account on each trade, which of course 10% is still kind of high. I'm just talking if you want to take higher risk to make a higher reward like $1.6 million. If you want to make $1.6 million, obviously you're going to have to take a little bit more risk than the average 2 to 5% that most people talk about. But if you had split up those 10 trades, say for example, and only use 10% of your account, you could have still made $1.6 million, but at a much safer rate and without risking your whole account on each one trade. So that's what I mean, and again, if you don't have a $65,000 account, well, it may not be that realistic for you to make $1.6 million off of a $5,000 account or a $10,000 account. We want to be realistic about the markets and stuff. So I just wanted to mention this real quick briefly about risk management and some of the things that have been mentioned in the past, and that you can actually still make, a good, much more than what the average market returns each year, using spreads and using some of these techniques that we're going to be showing you tonight. But you have to be smart. You have to use good risk management. And this is a good example. Google and Priceline didn't work out in October. And we don't mind mentioning that because even though something may have worked 100% in the past, it's not guaranteed this year. But it still has a high probability. If you take, 10 trades throughout the year that have made 100%, you may only make, money on 80, maybe 8 out of those 10, 80%. But again, if you make money on 8 out of the 10, you'll still be vastly more profitable than just doing a lot of other methods that are out there that people teach. So in this example, I lost money on Google and I lost money on Priceline last October. But I made all that money back and then some just on this one Netflix trade, because I'm risking less than what I make on each trade. So I only made 250%. I didn't quite make the full 100% some people made.
And was that overnight, Bret?
But that was overnight.
Okay.
I was not crying the next day. And so even though I lost about 50% on each of the Google and Priceline trades, I more than made that money. I made that money up on one trade versus what I lost on the 2 trades. And that's what I mean as far as, the seasonal trades are great. They're still high probability. Are they perfect 100% every time? No, of course not. But they are high probability. And so if you don't risk your whole account, if I would have risked my whole account on the Google or Netflix trade, I would have been wiped out on those trades because they didn't work this year. You want to make sure that you're using proper risk management and just make sure you're being reasonable about what your expectations are in the markets. So that being said, let's get on to the second trading method that's in best choice, and that's the high price consistency stock trading method. And initially, we're not going to go too much into using the wizards and stuff because those are all in the videos, and I'm sure you guys have seen those before. But you guys should know what the search primary conditions are: the initial conditions, volume, stock price, and all those things. The only thing that we add to find these types of stocks is we add the 1-year price growth, and we want to make sure that that growth is at least 30% or more. And then we also add the 1-year price consistency for, I think that's a bug. That should be 30% also. I apologize. I'm not going to edit that right now because it'd be kind of hard to get back here, but this should be 30%. So I apologize. That was a typo on my part since I'm the one that did these. So let's talk about another great trade this week that falls in line with this method, which is Southwest Airlines, which I think Pete wants to talk about a little bit because he took advantage of this.
Yeah, I want to talk about it, but I want to first mention something about our wizards. I always say to people, first of all, you got to know what you're looking for before you use the wizards, because how can you find what you're looking for if you don't know what you're looking for? So this is what this part of the training is about, showing you what you should be looking for so when you go to the Wizards, you have an idea. So this is, I'm going to show you my Southwest Airlines trade this week. With Southwest Airlines, it's a great company. It has an annual growth rate of over 100%, and the earnings also are at 92%. If we put the earnings up down there, that would be parallel, but that's okay. We're just looking at the price action. This is a stock that last year, almost the whole year, I had long-term calls on it. It's a great company. And why are the airlines going up? Well, oil prices have been dropping. And so if you think about it, I mean, oil prices since June of last year, when it was $100 a barrel, to now it's $50 a barrel. Who's benefiting? All users of oil. Airlines, trucking industries, certainly the consumers out there that are putting gas in their car, all users are benefiting. So I like the airline stocks. Now, on Friday this past week, notice this stock has beautiful narrow bands. And on Friday, we were below the bands. Now, I knew on Monday, Delta, which is another airlines, was coming out with their earnings. And when they announced their earnings on Monday, the stock jumped $3. Well, Southwest was going to announce their earnings on the 22nd, yesterday morning. And so I'm ready. I want to get in. I like the stock. It's below the bands. The earnings are coming out. So I bought calls, near-term calls that expire today, at the $40 calls for less than $1. Okay, let's see what happened. Okay, on the morning of the 22nd, yesterday, Southwest Airlines announced their earnings and the stock rose $3.52. You see that big jump in the price action right there from the prior day's close. The stock was now $45.70. Where are we? We're above the upper bands. I just had a 5-bagger in 3 days, 2 or 3 days. It's above the bands. Are you kidding me? See ya. I'm going to the bank. I'm out of here.
5-bagger, is that 500%?
That's 500% in 2 or 3 days. There's nothing wrong with that. Do I still like Southwest Airlines? It is a great stock. But right now, the stock is high. Give it a chance to pull back. I'm going to go after it again, and I like the stock. So that's showing you what you should be looking for. These are the kind of stocks. Notice that has nice narrow bands, which is a high price consistency. Now, if you look down on your legend in the lower right-hand corner, you can see the price consistency and the earnings consistency. The price consistency is 98%. That's extremely high. That means that the price is almost going straight up on a straight line. It's a great stock, very low volatility. That's kind of what you like to see. So let's move on a little bit here, Brett.
All right. Before we go on to the next stock, let me go into the program and pull up LUV real quick, because LUV is actually a stock that fits 2 different types of criteria. Okay, you can see here it's just been cooking. Like Pete said, it's very tight band, so very high consistency. You can see the earnings on this chart. The earnings are growing right along with price. You can see here 98%, 121%.
Killer company.
This is a stock that you can trade actually 2 different ways. You can trade the high consistency like he did, where it got below the bands, although in this example we'd be looking at this time frame, which we'll be showing you in here in a little bit how we select the proper time frames. But you can see it got below the bands, and so he just did a quick trade on there. I actually have options on LUV, but I have options out to, and I forget exactly which expiration, but it's like 6 months from now. We got below the bands. I want to trade this on the longer term, and we'll be getting into the longer term stocks here in a little bit also, but this kind of fits both criteria, where it's a high earnings growth for long term, but it's also a great high consistencies trade where the stock gets below the bands, trade it for a month or 2, it gets above the bands, take your profits, and wait for it to get back down below the bands. And so I am actually trading this on the longer term. I still own my calls, even though the stock got pretty high up here in the last couple of days. What I'm going to do is I'm going to then start selling shorter term calls, and create either a calendar spread or a diagonal spread, and we'll be getting into that here in a little bit too, where I want to hold this for 5 or 6 months. I want to keep capturing these gains as the stock keeps going higher, but in the short term, when it does these little pullbacks, or even gets above the bands on the short term, I'll sell some premium on there. And so a lot of times you can sell more premium over each month than what your original long call cost you in the first place, and you can even double your results versus just holding the long call over the long term. So I did want to mention that real quick, but we talked about as far as how to find these stocks. We mentioned a few minutes ago the criteria we look for, these stocks, and that you put that criteria in the wizard, and you're going to find these types of stocks. The next one that we're going to talk about was Lockheed Martin Lmt. I'll type that in here. Now this one here, and again, there's 2 different types of trading types that we're going to be talking about tonight besides the seasonal stuff. All right, yes, the growth on the earnings on LMT is not as much as the price growth right now, but take a look at the PE ratio over here. The PE ratio shows the price to the earnings ratio, and the lower this number is, that means that, in this case, in this example, if this is anywhere below 30 and even below 20, that means that the price of the stock is still low versus how much the company is making. So even though the growth of the earnings may not be moving at the same rate that the price is, the price itself is still going gangbusters, and it's still a great trading stock, at least on the shorter term. So these are the types of stocks that you will find, like LMT and Southwest Airlines, among other ones. And again, we've got a whole list of stocks here at the end of the presentation that we'll leave that slide up for you guys to write these stocks down. You guys can on your own time take a look at these stocks. You guys can also, with the criteria we're giving you guys for the search wizard, you can use the search wizard on your own time and find these different stocks and start going through them and start looking through them. And the main thing is, you want to find these stocks that have these nice tight bands, because that means there's less volatility and they're a lot easier to trade. You want stocks that are easy to trade. You don't want stocks that are hard to trade, that are volatility, that are just all over the place. You want these nice, easy, tight bands, and you just go along with the trend. That's all you're basically doing, and Best Choice obviously will show you how to find these stocks. So let's go on to the next stock here, or the next slide. We're in the calendar spreads. Now we're going to start talking about what I just started to mention to you, but I'll let Pete go ahead and read this to you since this is his.
Okay, we'll be talking about calendar spreads, but maybe at this point in time, we're nearing the halfway mark, Brett. Maybe we take a look at a couple of questions, possibly.
Yeah, actually, that's great.
Let's look at a few minutes here on questions that you guys have been asking us.
Yeah, we don't want to get too far and leave you guys if you guys got some questions about some specific things. So let's pull up our chat box here. And I'm a little concerned because, we could probably go to midnight if we're not careful. We want to try and answer at least, as many of your questions as we can. So let's come and pull this up here, and let's go back up to the top.
We have a slew of questions.
Yeah, we got a lot of them. Well, let me see here real quick, and let's see. If someone asks if you're going to be receiving a recording of the webinar, this webinar will be recorded, and you guys will be getting the link for that. Let's see here. We have a lot of comments, and so comments are no problem. We don't mind comments, but we mainly want to try and answer some questions here, some specific question. Michael has said, so what was the optimum choice of an option? And that can be sometimes a problem because there's so many options and so many option strategies that it can't. Like in the case of Google that I mentioned before, I didn't know how far it was going to go, so there will be times where a call option will outperform my spread just because you don't always know how far a stock's going to go. It just depends on the volatility of what's happening at the time. But over the long run, as you guys saw on that chart on Google, Google tends to make a lot more smaller moves than the great big moves, and I want to take advantage of making money more often than less often. So that's why I personally like to trade spreads more than straight calls. Also because if the stock doesn't move right away, I'm not losing money on time value on those long calls versus if I'm holding a spread. Did you have
one quick point on that. You can maybe look at some of the other questions.
Yeah, go ahead. Yeah.
On selecting an option, this is why we want to, like on the Netflix trade, I showed you how we could estimate about a $68 move. And, of course, that was for a 7-day time period when the earnings were coming out. That is a massive move. That's many, many strike levels. And so you want to be that's the average. That means sometimes it's above that. Like this year, I showed you, it was like 70 some odd dollars. It was more than the 68. But some years it's going to be less than that. So I'm a little bit on the conservative side. I just want to win. I just want to make money. Am I happy making 100% overnight? Yeah. Would I be more happy if I made 600% overnight? Well, yeah, of course. But what if I lost? What if it didn't make the move? You see, so I tend to be more conservative. But there's plenty of these trades. The whole point of what we're showing you tonight is learning how to do it.
Mm-hmm.
Go ahead.
Yep. All right. You got some great questions here. I wanted to answer here real quick. Somebody asked, who is Gary and his group? That's a great question. We'll be giving you guys some more information about him and his group here at the end of the webinar. Michael also asked, are you urging weekly options? And I would say typically on most best choice trades, you're not going to use weekly options typically. Most of the trades from best choice last at least 2 weeks for the seasonal. Obviously on the longer term trades they're going to be even longer. And if you're looking for a trade that's going to last 2 weeks, you don't want to be doing weekly options that expire right at the end of those 2 weeks. Of course, it depends if you're doing spreads or straight calls, but typically you still want to be doing monthly options on those. I know weekly options are sexy and everybody's into them and stuff, and they are great for certain things, but really weekly options are best used for swing trading, very short-term trades that last less than a week. I did use a weekly on our Netflix trade. In fact, Pete and I both did use weeklies because we knew that we were going to only hold, at least for that trade, overnight. So there's no point in doing a monthly option on a trade you're only holding overnight. So it all comes down to your time frame. Are you going to hold this trade for 2 weeks, 2 months, or just overnight? Just overnight you don't need to use more than a weekly, but it really comes down to your time frame.
Now we have a good question there. When is our next cruise? Now we are planning a cruise next month. Yep. It's February.
We're going to talk about that at the end.
28th. We're going to talk about it at the end, but you can still get into it. There still are a few cabins available.
Yep.
But we already have, I think, 60 some odd people signed up for it.
But we do have cabins available.
We're going to have a blast. This is our 5th cruise. We have a lot of training on board the ship. Great camaraderie. You have a blast.
It's a great time.
It's going down to we're going down to Labadee, Haiti. We're going to Jamaica, and I think Cozumel, Mexico.
Yep.
Middle of winter down here in Florida. It's really nice. So if you'd like to cruise, give us a call there. Talk to Linda about that.
A couple of things here real quick. Anthony, actually let me answer Brian's question first real quick. He asked, are spreads that we're talking about, are they debit and not credit spreads? And that's correct. I don't like to do credit spreads because on credit spreads you are risking more than what you make. For those of you that are familiar with credit spreads, typically you're trying to do out-of-the-money credit spreads, hoping the stock doesn't hit your strikes, and you're trying to go after maybe 10 or 15%, or some people are only going after 5% profits. But that automatically means if they're only going after a 5% profit, their risk is 95%. And that means that they have to be right almost virtually all the time. And as most of us know, it's tough being right most of the time when it comes to trading. So we don't like to recommend credit spreads. We like to do directional trades, debit spreads. And another reason why debit spreads are so much better than credit spreads is we typically try and teach people to use our software to trade direction. Like Pete had mentioned earlier when he first talked about the vertical spreads, which are debit spreads, is, if you're trading with the trend, well, the moves that are in the direction of the trend are always going to be bigger moves than the pullbacks. And so if you're trading those moves, you're trading the bigger part of the move, and you're going to make much more money taking advantage of debit spreads than you were trying to trade credit spreads. So, in Best Choice, we're all about trying to help you maximize your trading success, and we feel like debit spreads are much better than credit spreads. We also had a question here real quick about Apple, earnings coming up with Apple. Apple used to be a great earnings trade until they had their splits. And I say splits plural because they did a 7-to-1. I mean, they couldn't just do like a 1-for-2 when it comes down to like a $350 stock. No, now it's down to a $100 stock. And really, the stocks that make the best overnight trades are the stocks that are more expensive. The Pricelines, the Netflix,
the big dogs.
The big dogs, absolutely. So if you look up, I'm not going to take time to look at Apple right now in the seasonals, but the Apple trade, seasonals right now are not really that great. They're not 100%. I think they're only like 70 to 80%. So Apple is not something that we're currently recommending, at least for Pete and I. Now,
so are you trying to say Apple was a big dog, but after all the splits, it's now a little dog?
It's a Fifi.
Okay. Okay.
So
let's move on.
Yeah,
here.
we got a few more questions coming in. We're going to have to put those on for hold for a little bit longer because
we'll have another question.
We'll have another question.
There's a lot of questions coming in, and we love the questions.
And also, well, I mean, I don't want to talk about Gary too soon because we were going to talk about him at the end, but he can answer a lot of your questions for you. I highly recommend that you guys get in his group. He has a group that meets every week. It's only $99 a month. You're going to get so much for that money. You can ask them anything you want, anytime you want. They go over current trades. For those of you guys that missed the Netflix trade this time around, everybody in this group was talking about it before, and as far as I know, I mean, I can't imagine anybody not taking the Netflix trade that was in this group. So anyway, as Pete said, let's go ahead and keep moving because, we don't want to keep you guys here till midnight tonight. Let's go ahead and minimize this and yeah, go ahead, Pete. You want to talk about some calendar spreads?
Okay, let's get into calendar spreads. Now, for a great growth stock, what a calendar spread is, you're buying a long-term option on it and selling a short-term option at pretty much at the same strike level.
This should be strike. This is a typo.
Same strike level, but it's on the same stock as well.
Yeah, but different expirations though.
Different expiration dates, and I'm going to give you an example so you understand this. So basically what you're trying to do is hold on to the long-term option. And you use the short-term option to hedge yourself against volatility, and it's going to decay faster. So the short-term option, sometimes you're going to have it, you can sell it, you can be in and out a lot with the short-term option, but I like to think of the long-term option as the anchor. That's the one that's your money maker. So preferably what you want to do when we see these swings up and down, you want, if the stock is blasting to the upside, you just want to be long.
Is there any stocks you've seen lately that are blasting to the upside?
Quite a few.
Southwest Airlines?
Yeah, Southwest, yeah, that was great. I mean, I didn't want to have a calendar spread these last 2 or 3 days.
No, because you don't want to be short the option when the stock is roaring higher.
Yes.
You only want to be short that option when it's starting to pull back.
Pull back, and you can hedge yourself.
Exactly. So
now,
click on the next one?
Let's go ahead and I'll give you, let's take a look. I'll give you an example. Now, like I said there at the bottom, right now, because Southwest Airlines, the last 3 days, it just had that $5 or $6 move, and it's right above the upper bands. This is not the time to put it on.
So
no, I just wanted to go to this.
Oh, sorry.
Back to the PowerPoint.
That's no problem.
Okay, go to the next
slide.
Yeah.
All right.
Okay, so in Best Choice, if you click on your options chain, which
is this right here?
Yeah, this is what you would see on Southwest Airlines. Now, I clicked on the September option, which gives me.
Oops, sorry, I clicked on. Let me go back. Here we go.
It gives me over 200 days, okay, to hold on to the option. Now, the at-the-money option, if we look down in the chart, we can see the 45 is the at-the-money, because the stock is currently $45.35. That's the closest option to that strike. Is going to cost $5.40. That is the ask. Maybe you can get it cheaper, somewhere between the bid and ask, but you can definitely get it at the ask for $5.40. So now, if we take that $5.40 divided by $45, it annualizes to an 18% premium. If we look under, there's a column down below, it says annual, and if you look in the annual, right in the center, it says 18%. Okay, it's just like if you had money in the bank and you got an 18% return on it, okay? I came up with this idea because it standardizes these options. Just like, when you have money, if a bank said, I'll give you $3 interest on $1,000 a month, well, that's great, but what is that? What's the annual percentage rate? APR, they call it. When you annualize something, you standardize it. So it doesn't matter whether I'm looking at a 9-month option, a 1-month option. When I look at that annual column, I've standardized everything. So I know I don't mind paying an 18% premium to lock in a stock that's been growing at 100%. That sounds like a pretty good deal to me. So, okay, that's the option, maybe buying a long-term option. Okay, so now let's look at what the short-term options.
I'm just going to click this and wait for it to come up while you're going, and I want to show them
what it actually looks like live.
Yes,
Okay,
exactly.
sure.
Yeah, go ahead.
Okay, so now,
oops, sorry.
go ahead. Yeah.
I'm sorry. I'll just do this real quick, and then I'll go back to here. Sorry.
Okay.
Well, actually, we should talk about that real quick while you're talking about it. Here's that 18% that he's talking about. You know, the options.
The slope of the line
is 18%. But yet the stock is growing here at 100%.
And that's the slope of that line.
It's costing you 18% here on these options. Actually, the September options are right here. So it's costing you 18% to take advantage of a 100% growth rate. So where do you, I mean, right, if the stock didn't go anywhere for the next, between now and September, of course, these options would expire worthless. But if the stock continues along where it's showing here with the growth rate, well, look how much profit, your profit's going to be the difference here between what the 18% you
paid,
where you bought it, right, and then up here versus up here, where you're selling it way up here. And that's what he's talking about as far as comparing those annualized amounts on different options and what those annualized numbers actually mean. You can see here in our software, they're actually plotted on the chart, the same chart that you can see with the price growth rates and stuff, and you can see for yourself the visual difference between how much it's costing you for that option versus what you can expect in that stock if it continues up in this direction.
Right, and so, that's another killer chart.
Yeah, you won't see this anywhere
else. That's something that we created.
Yep.
You know, to visualize this stuff.
This was a Peter original.
That's one of my.
This was pretty impressive, actually.
It took a long time for Bret to understand.
I had to program it.
He had a program. I knew in my mind what I wanted to see, and finally he got it. He understood it.
Yep.
So, okay. Sorry. Which also brings me back to the seasonals. Tell you another story about that seasonal chart. When we created that originally, and I showed it to Sonny for the first time, I said, Sonny, you got to see my new baby. And I showed him the seasonal chart. I didn't explain it, and he saw all those lines all over the place, and he said to me, Pete, your new baby, you got the ugliest baby I've ever seen. You can't show that to people.
We'll never sell this.
He will never sell it. I think after using it, he certainly looks at it a lot differently.
Sure.
Well, anyway, getting back on the February option, this is February 20th. This is a short-term option. You're only talking about 20-some-odd days.
Calendar spreads we're talking about, right?
We're talking about calendar spreads. This is selling the short-term option. You're buying the long-term one, and you're selling the short-term one.
So we bought the 45 September.
Right.
And now we're looking at the
Now we're looking at the, yes. Okay. The at-the-money option, if we look down there, the $45 is currently, the bid is $1.95. That means that's what somebody is willing to pay you for it.
And that's where you can sell it.
That's where you can sell it. So now if we look at the annualized column on the short term, the annualized, my God, those people are paying 57% annualized. So you bought it at 18%, and you're covering yourself with a 57%. So the premium on the short-term option is dropping 3 times faster than the one on the long-term option. So if you bought the long and you sold the short, your cost drops. So you paid $5.40, you got $1.95 back. Your total cost is $3.45. Now, if the stock stays at the same price of $45 come February 20th, what's going to happen to your short-term option? It's going to expire worthless. Okay, the guy who you sold it to lost his $1.95 to you, and guess what you can do? You still have your long-term option that lasts till September. You can sell the March, you can sell the April, you can sell the May, you can sell the June, and so on. You can do this month after month, keep selling that short-term option and collecting premium.
Your long call was $5.40?
$5.40.
Okay, that's one thing I wanted to mention. All right, this is about a month away from when this picture was taken. All right, well, how many months between now and September? 9 months? So multiply this, almost $2 times 9. That's $1,800 of premium you can sell versus your long call, which only costs you $5.40. So that's what we talk about, mentioned earlier, about being able to sell much more premium over the coming months versus how much your long call costs you. Plus, you can make money to the upside as well on these great growth stocks. So that's why we like calendar spreads, and why I was showing you guys earlier, even though Pete did a short-term trade on Southwest Airlines, I'm still holding my long call. I actually didn't do the September. I did the one, I think I'm either in June or July. And so, I'm looking at that as a longer-term play where I'm going to be selling premium probably here pretty quick. We've gotten above the bands, but we haven't quite started pulling back yet. And so we could continue going up over the next few days. You know, I don't try and predict what the market's going to do. I only try and do or follow along what it's actually doing. But this is a great example of what calendar spreads are like and how you can take them to your advantage, because you buy the long call when the stock is below the bands, let it move up a little bit. It may only move to the middle of the bands. That's fine. Then sell some premium there. Let it kind of pull back a little bit and do its thing, and then you buy it back either for less than you bought it for, or let it expire worthless, depending on what the stock's doing. And then when the stock keeps chugging higher, then you're just long that call until it starts to pull back again. And this is a great strategy, very low risk. I mean, yes, there are times if the stock does move below, and this happens from time to time too. In fact, this is probably a good example. Let me turn these off here real quick. Micron Technology, we're going to be talking about that in a little bit. Great growth on the earnings. Still not quite as good, but I mean 500% on the earnings, 118% on the price. That's pretty great. You can see here I got in below the bands right here, and then we moved a little bit lower. That can happen sometimes. Just because we're below the bands doesn't mean it can't move lower on a short-term basis. But all I did was when I started rolling over here, I was sold a near-term monthly call. And it's not protecting me 100%. I do have a small loss here, but I have a much smaller loss than if I was just holding on to the call. So these short-term premium that you can sell against your long call can probably hedge you at least 80% of your stock. I'm still, a great believer in this stock. It's got great growth on the earnings. It's got great growth on the price. But on the short term, like we all know, stocks bounce around. They can sometimes move against you a little bit. But doing calendar spreads is a great way to hedge yourself. And this is what hedge funds do. They don't call them hedge funds for nothing, do they?
Yeah. They want to protect themselves.
This is what they do. And something else I wanted to mention also, a lot of other companies out there, say, well, 80% of options expire worthless, and they're trying to use that to say, well, you should be selling options. We agree that you should sell options, but only against options you own. You should never sell naked puts or do naked options. And the main reason why you shouldn't do that is because if you do a put spread instead of a naked put, your risk-reward ratio is vastly more superior than doing a naked put. So you never want to do option selling by itself. You always want to do it in the context of using a spread. That's the way you're going to get that, because the margin on a naked put is so high versus your reward. By doing a spread, you're basically reducing your margin yourself. And so you're able to reduce your cost basis much more, and your risk is therefore going to be much less than naked puts or naked calls. So I just wanted to throw that in there as well without taking up too much extra time. So let's see what's on our next slide. Oh, go ahead, Pete.
Okay. Now, this is a chart. This is not a best choice software chart. This is a chart from Thinkorswim. And this is what your profit loss looks like on the Thinkorswim Analysis tab. Now, this one would be the exact same spread that I explained, that we are buying the September and selling the February 45.
And here's our 45 strike right here in the middle.
45 strike is in the middle. So basically we can see that the red line peaks out there. That's our maximum profit. Now, where do the lines cross over? We can see that the light shaded area is our profit zone, all the way from pretty much $40 all the way up to $50. So anywhere, as long as the stock stays in that $40 to $50, you're not going to be a loser. Okay.
Actually, no, it's 42 is your break even.
Is it okay? Is
and 49.
49. Right there is your break even. Okay. Yep. So you've got a pretty wide range that this stock can kind of meander around, and you're still in good shape. Okay. Now, if this is what you're hedging yourself against the volatility and just a slight move one way or another. Now, if the stock just wants to blast up, you just want to be long. Or in a vertical spread. You really don't want to hedge yourself at that point in time.
Because if it does move too much, you will actually have a loss, because the loss on the short-term short call will overtake the profit that you have on the long call. And that's why this goes below this. If you notice here, this is your profit axis over here, and here's your zero line. And anything below here, you're actually at a loss. So like Pete mentioned, you've got a big wide range here where you can see a profit. But if it does, start moving it hugely, and if you notice here, if the stock does start moving up, your profits are going down. This is why we suggest people not be short those calls if the stock is moving higher, because you're missing out on profits you could be making if you were just long the call.
Now one other key thing about this profit loss chart is this only lasts for the duration of the short-term option. Remember, you sold that option and it's only 20 some odd days. So this hedge is only a very short-term option, and that short-term option is going to expire. It may expire worthless. Again, you may want to roll it to the next month if it still has some premium left. In which case, you're doing it's lost its time value, but you're selling more from the next month. Absolutely. So this is a really cool chart. It shows you the range that you have to play with. And now, of course, we talked about if the stock blasts up, you just want to be long. If the stock crashes hard, what is that telling you? You've made a mistake. Okay, you could hedge yourself just so much, but you expected this great growth stock to go up. If it's crashing, it's not doing what you're expecting. Okay, bail out.
Now, well, there's another way you can trade this, and this is what I do. If the stock does start moving down, okay, once you get past a certain point, okay, this 45 short strike that we would have would be worth very little, 40, 50 cents. If the stock is still continuing to move down and you still want to hold on to the stock, you can roll, like you mentioned, you can roll out of that short-term stock at that strike. Like say, for example, if we're down here at $43, for an example, we could we could buy back the 45 strike that we were short, buy it back for much less than we sold it for, make a profit on that, and then we could roll to the 43 strike, which is the current at-the-money strike, and for more premium as it continues down, and continue keeping our hedge on as much as we can. So there's a lot of different things you can do with that. And we were talking about this earlier. We do plan on doing some more webinars coming up here to kind of go into this more. We want to, try and keep you guys educated and, teach you guys some of this stuff that's out there in case you guys don't understand this. So that is also something that's in the works that's going to be coming up fairly soon as well. So you ready to go on to the next slide? Yep. So, okay. So now here, we talked about the high consistency trading where we were focusing on the price growth, the yellow bands. And those are a little bit more shorter term trades, maybe 2 or 3 months, sometimes in the case of like, our recent trade with Southwest, a couple days. But this strategy also uses what we call our long-term charts, but this also has a little bit more of a focus on the earnings. This is a little bit more of a longer term strategy, like what I'm doing currently with Southwest, where I'm buying 6 months out. You could even on some of these stocks buy leaps, further out, and then keep selling premium every month against those. That's what these are. And don't forget, this is the bullish time of the year. For those of you guys who have seen, well, in fact, let me just pull up real quick. What do you like? What's the symbol you like looking at as far as the overall markets this time of year?
You get DIA for the Dow?
Yeah, the Dow. But actually, I think I have a SPY up a little bit more clear. And then let me pull up here instead of January through December. For those of you guys that haven't seen this, let me start here in August. And you can see here from the October time frame all the way to May, the market just on average, and I think this is like an 85, 87% average over the last like 100 years. I'm not showing 100 years of data here, but it looks pretty much the same. The markets are mostly bullish during this time of year. If you guys have read some of the stock almanacs, I forget the author's name that wrote those. But,
sell in May and go away.
You've heard the term sell in May and go away.
Of course, you want to come back in late October there, right, where this move starts.
Yep. So we're right in the middle of this time frame right now, where the stocks over the most of the last 100 years tend to be bullish from the October to the May time frame. And then if I pull this up here, let me change this to, I think you see here in January. You can see here once we get into May, we just flatten out, during this time frame. Now it's not to say that stocks don't move up and down, but if you buy in May and sell in September, you haven't made typically on average any money. This is the time you want to be making money in stocks between October and May. And so that's what we're talking about here. Here, don't forget, this is a bullish time of year right now. This is the time to be making money to the upside overall, at least on the longer term. Of course, short term, anything can happen. But these long-term high earnings growth stocks that we're going to talk about now are a little bit different. They're a little bit longer term holds. They tend to be, they have great growth. I mean, if you want to hold a stock, and again, some of you guys may not like options, you may just want to hold on to the stock, and that's fine too. You may not make as much as option traders, but these are the types of stocks that you can hold sometimes for 1, 2, and 3 years. Yes, sure, buy and hold for 10 or 20 years doesn't work very well anymore, but you can buy and hold for a 1, 2 year on some of these stocks. I mean, Southwest is a great example here.
Well, of course, the summertime with a relatively flat market, you can do a lot of calendar spreads.
Would anybody like to be able to go back 2 years ago and buy Southwest for $11? I mean, you know, there are stocks that do this, that continue to do this over 1 and 2 years, that just keep cooking. And these are the signs. And the other thing too, that, you know, looking for these high earnings growth rate stocks. Okay.
So, let me tell you one story. You know,
I think you interrupted me.
I know, but
well, okay.
I want to
go ahead, please.
You know, because it just brought up a point. You
well,
know,
I hope I don't forget.
When I originally built this software, looking for these great growth rate stocks, you know, I talked about Netflix earlier. It reminded me of AOL. Now, do you remember 20 years ago where to connect to the internet, it used to cost $1.95 a minute?
I remember something like that. It was not cheap.
$1.95 a minute to connect to the internet. This broadcast tonight would cost you $200 just to listen to it. Okay? Well, AOL said, wait a minute, why don't we charge $29 a month and you can connect all you want? The stock went nuts.
Kind of like Netflix did?
Just like Netflix. The stock, $1,000 invested 2 years later would have been $1 million.
So good ideas are good and bad ideas are bad.
Right. When people pay for a month, all you want to use it, they like it. When you're charging per minute or Netflix was charging per view, people don't like that.
Right.
Okay.
So what I was getting ready to say was, when it comes to these types of stocks, okay, Best Choice helps you find the companies that are making money. If you're going to be involved in a stock, you want to be involved in a stock that's making money, and that's what these earnings points are showing you, that the company is continuing to make more and more money every quarter. And so these are, you have to remember and think about this, especially those of you guys that understand options. Options give you leverage. What kind of return on an option are you going to make if the stock moves up 10%? A lot of times you can make almost 100% return on the options if the stock moves up 10%. I was even showing you guys some spreads where I can make 100% return on the spread for only like a 2% or move on the stock. And here you have a company like Southwest Airlines. It's growing at 100%, and this is the stock price that's growing 100%. How much money do you think you can make on the options if the stock price is making 100 or moving up 100% a year? And so I think people think, well, you know, the seasonals, that's kind of the, you know, the trades where you make the most money. They're shorter term. You can make a boatload on these longer term plays if you know when to get in, when they're below the bands, you know, when to sell some premium after it's moved up and it's starting to go sideways or starting to pull back a little bit, and then just let it keep on chugging. You can make a boatload of money with these. And so this is why we wanted to kind of spend a little bit of time with you tonight showing you some of this stuff, because I think over the years, you know, we kind of got focused mostly on the seasonal stuff and kind of forgot about some of these other trading methods that are in Best Choice. And personally, I am actually right now trading more of these types of stocks than I am on the seasonals. Am I going to ignore the Netflix trades? Absolutely not. But I mean, I'm actually finding more trades every month trading these types of stocks. And again, I've got a good 20 stocks, you know, probably about 10 stocks each of each of these types of kinds, 10 of the high consistency stocks, and then 10 of the higher earnings growth stocks. There's plenty of stocks out there, but then also you can be selling premium every month. Also, there's plenty of trades to find with these types of stocks. So I know we keep chasing these rabbit trails. Here's the search conditions I'm looking for on the earnings. If you remember, we had the price growth also for 30% on the high consistency trading method, but on the other one we were focusing on the price consistency for our second search criteria. Where this one, we're not so concerned about the price criteria, although you still want to kind of find, you know, the ones that aren't too volatile. But we're also adding in here the earnings growth also for 30% or more. And this is going to give you a search list of stocks, probably of double the stocks that you actually want to watch, because some are going to be more volatile than you really want to watch. And we'll show you some examples here in a few minutes also of those. But I personally like to widen my search a little bit more. I think, Pete, you originally were using 50% originally a long time ago.
Right.
But I like looking at stocks because the more stocks I look at, the more opportunities I find. And it's real simple to discard the ones I don't like versus finding the ones I don't find because they weren't in my search list to begin with, right? So let's show you a couple of examples here of some high earnings growth stocks. Again, we got plenty more stocks we're going to give you here at the end of the webinar. But let's pull up Disney here. And here's another great stock. It's been growing now. It hasn't been growing quite as much as Southwest. It's only got about a 30% price growth and a 22% earnings growth. But again, you want to diversify. You don't want all your eggs in one basket. You don't want to only trade just the best one or two of these types of stocks. And again, even at 32% price growth, with your trading options on these, you can still make plenty of money trading stocks like this. And a lot of this too, a lot of people like to trade stocks that they know. We could give you a whole bunch of symbols and you're like, I've never even heard of this before. Disney, everybody knows Disney. Disney's been making some great buying, or not buyouts, but they bought obviously LucasArts. They're doing the Star Wars movies. They've been doing all kinds of acquisitions. Pixar. They purchased Pixar. They've been making some really smart acquisitions, and they're making money. They're making consistent money, and this is the kind of stuff that you want to find. Now, if you look at this, this one actually wouldn't be a bad high consistency trader on a shorter term because you can see usually when we get down below the bands, it's not more than a couple months before we're above the bands. We get back down below the bands, and then here within a month we got above the bands. We get back down here. Now this one didn't get quite down below the bands, but we had a nice little double bottom. We made a higher high with a pullback. So that's just basic technical analysis, trading with the trend. As long as the stock is trading in the direction of the trend, you can get in anywhere here. You don't have to wait for it to get below the bands. Obviously, the more you wait below for the stock to get below the bands, the lower your risk will be. But then you might miss out on some of these trades too. So again, there's no perfect way to trade. Everybody's got different risk tolerances. All we can do is show you the different opportunities, and you trade this the way you want. If you want to trade this on a shorter term basis, above and below the bands, or if you want to do a longer term basis on this where you're doing calendar spreads, that's up to you as far as your risk tolerances and how you like to trade. There really isn't, there's actually, well, I shouldn't say that. There is a lot of bad ways to trade. But when it comes to good, trading strategies like this, you can do it different ways. You could even do it both ways, where you're doing half of your position as a calendar spread longer term, and then the other half with some sort of shorter term trades. It's all depending on how sophisticated you want to and how much time you have. Also, sure, some of this takes some time as well. But Disney was the first one we wanted to show you. But then let's pull up Canadian Pacific Railway. Just to show you the difference between the two, because there are some other stocks here. This one here has a price growth of 36%. And an earnings growth rate of 50%. You can see right now we're below the bands. This is a nice low risk entry point for getting into this stock. Again, if you want to hold it for 6 months, and this is something that we try and tell people too, look at how the stock moves. Does it move up quickly within a few months, or does it take sometimes 6 months to get above the bands? And use that as a criteria for what kind of a time frame you want to place a trade, whether it's a 6-month trade or even leaps. There's nothing wrong with leaps either, because you can always sell premium when it's moving to the downside. Or do you want to do a 2 or 3 month trade and just capture quick movements to the upside? Again, it all comes down to your trading strategies and the way you like to trade also. On a lot of these stocks, there isn't a really wrong way to trade.
One thing to point out, notice on the price consistency is much lower on this. Remember when we were looking at Southwest Airlines, which was virtually straight up, was a 98% consistency. Yep. This one's down around 93.
So that just means that these bands are a little wider. There's a little more volatility into it. You might consider it as being a little bit more risky than the other one, but it's still not that you can't make money with it all day long. So I know Pete likes those super tight bands, and he likes just sticking with those stocks. Me, I don't mind taking a little bit extra risk and trading some of these that have a little bit more volatility. But again, that's like I was just saying. I don't mind taking a little bit more risk where Pete likes to be more conservative, and there's nothing wrong with either way. Sure, ultimately one person may end up making more money than the other, but in the end, usually it averages out because one stock that you might be thinking might be volatile right now may stop being so volatile for the next 6 months. You just don't know. So you can't predict those types of things. All you can do is trade based upon what you know, and that's what our software tries to help you to do, is give you the most information that we can give you. So here's a couple more here. We got Gilead Sciences. I'm in this trade here. I'm in this stock. I'm not in CP yet. I need to get in here pretty soon. But here's another example too. I got in Guild back here in December. And it started trying like it was going to head to the upside, and then we dropped down a little bit. But now here we are already back to where I was in. So that's what I've noticed also about these really good growth stocks is it's hard to get hurt too much on them. I mean, sure, maybe 1 out of 10 might end up hurting you, but the vast majority of these guys, they don't move against you too much once they get below the bands. And again, you can always sell premium. You can see here we got an earnings growth rate here over the last year of 373%. And just real quick also, I wanted to show you guys this while I'm thinking about this. When I'm looking at a stock, I usually start with 2 years here on the long-term stocks. Just usually I don't want to look. The reason why I use 2 years is because
you might turn the earnings off.
Well, no, actually this is good because you can see here that the earnings were going down during this time frame. But the reason why I select 2 years initially to look at a stock is because usually I don't want to look at more than 2 years. So that's why I start with 2 years. But to help you guys select the best way to find the proper time frame to figure out, okay, well, is the stock here below the bands, or if I select a different time frame, it might be towards the middle of the bands. What you want to do is you want to, or I should say the right way to do this is where this is going to be on the extremes here as far as where it's above or below the bands. The best way to determine where this is make it based upon the last move of the stock. Okay, so what I do is I come back here to the last time that the stock was below the bands. Okay, and this is where I'm going to highlight, and this is, to me, the best way to determine, okay, where are we right now versus these yellow bands, and that's always going to be based upon what has been the latest move in the stock. Okay, now you can see the stock did, I'm sorry, I didn't mean to click on that. The stock has moved sideways since the last time it got above the bands, but I always start things starting from the last time the stock was below the bands, because that gives me the best way to determine where the stock currently is, because it's based upon the last move of the stock. So that's how I determine my time frames for any stock I'm looking at, whether it's Disney or any of the other ones that we're talking about tonight. I always start with 2 years, and then I select the last time the stock was below the bands to give me the best indication of where the stock is right now versus these yellow lines. And so you can see here we got one other one here. I've actually got 6 or 7 more besides these, but we just want to show you a few of these, at least at this point in the webinar. Skechers, some of you guys have heard about the shoes, SKX. This is a great looking chart. Let me come back out here to 2 years. Okay, you can see earnings have just been going gangbusters. I mean, without our software, you would have never have known that this company was killing it with their earnings. I mean, Skechers shoes, I mean, that's a kid's shoe, right? I mean, teenagers, I think it's their kind of shoe. Yet, you can see there's a lot of opportunity here. And you can see, okay, here, the last time we're below the bands is right here, so I'm going to highlight this right here. And you can see right now we're below the bands, all right, based upon the latest move of the stock. Okay, so this is a very low-risk entry. In fact, you can see here a beautiful little consolidation over the last 3 or 4 days. As most of you guys know, I have always taught in the past what I use for my timing technique for actually getting in the trade is I want to see us breaking out to the upside above the last minimum of 2 days. Okay, you can see we have about 4 days here. We haven't broken out to the upside yet, but I want to see a close above the high of the last minimum of 2 days. And then I typically use a 2-day trailing stop, as it's going higher before I start thinking about selling some premium. And so, again, this may move lower over the next month. Again, over the longer time frame, stocks obviously can do a lot of different things. But when you have this high growth, if you don't think institutions aren't looking at these types of stocks, because they're not stupid either. They want to find the best place to put their money as well. And these fundamentals are what institutions are looking for. And so institutions are not going to let a stock fall too far that's making this kind of money. And that's what is great about these types of stocks is that they are pretty safe. You're going to find that you're going to find about the same kind of consistency that we do on the seasonals. Probably about 9 out of every 10 stocks that have these types of growth rates, you're going to be able to make some pretty good money on. So again, let's keep moving because I know that time is flying.
10 minutes.
Well, I'm sure probably most people won't mind if we go over a few minutes. But anyway, These long-term and high-consistency trading methods create plenty of trades each month, both initially buying the longer-term calls and selling shorter-term calls against them. They are great for generating very good monthly income, even 10% or more. Pete's seen that, on most of his trades. And that was even when you weren't even trying to time it. You were just putting them on every month, and you were getting 10%.
Oh, yeah, I was killing them this last year.
And this was not even, trying to time it where you wait for it to move up first and then sell some premium, so you could be doing even more than 10%. I've been seeing that myself because I've been trying to time it more. And I even have Pete. Pete has never been a market timer in his life, and I've got him timing the market now. So that's actually been a pretty cool thing. So, but yeah, compare this to a lot of services out there that are trying to only give you credit spreads that are out past the 90% probability of getting hit, and you're only getting 2 or 3% returns on that. To me, this is a much better way to trade. And just as you wouldn't only want to trade one stock all the time, you should also diversify and trade multiple methods, not just only one method. That way you're diversifying, so in case one method's not working right now, but you got also some other methods that you're trading too, and that helps diversify your portfolio also, not just only beyond just different stocks.
We got a lot of tools in our toolbox.
Yep. So let me tell you the single largest thing by far, and I do mean by far, that has made the biggest difference in my trading results. Okay, and when you hear this for the first time, you're going to be thinking to yourself, well, that seems kind of obvious, but let me explain to you why. Okay, the single largest thing by far that has made the most difference in my trading results, and this really doesn't have anything to do with what we've talked about so far tonight, but I really want you guys to think about this in the next week or two, and that is looking at charts every day.
Well, I thought you were going to say best choice software, Brett.
I'm looking at best choice charts.
Well, best choice software.
I should have said that. I'm sorry. If you don't see the opportunities, you're missing the opportunity. You're missing those opportunities, and if you're not looking for them every day, and again, you don't have to do it every day, but I prefer doing it every day. I love looking at charts. It helps me to learn chart patterns and how the stocks move. But we had a lot of people this week that told us after the fact that they missed the Netflix trade, even though they own the software, because they're not paying attention. They're not looking at, and they're not using the software. And obviously, I'm not talking about anybody in Gary's group, because obviously they discussed this trade and were prepared. But it has made such a huge difference. I mean, even still, I'm not even perfect. I miss trades still, and I'm just like, oh, how did I miss that trade? If you're missing trades, you're missing profitable opportunities. And so this really, I consider this the biggest thing that has made the biggest difference. I look at charts every day. If you're longer-term traders, obviously you don't have to look at them every day. But I can promise you, I looking back over the years that I've been trading, if I get lazy or feel like taking a week off, and not that people shouldn't take a week off and take a vacation or that kind of thing, but I know for a fact that not watching and not looking for opportunities on a regular basis, not using the software every month, looking for the best seasonal trades, looking for the best long-term trades, and being consistent. How do you expect to be consistent in your trading if you're not consistently looking for trades? And you're not consistently trading using good risk management. You're only going to get consistent results by being consistent. And I know it seems obvious, and everybody's like, well, duh, but it's almost kind of a Zen thing, I guess. I really kind of reflected on it a lot over the last few years, and really came down to this really has been the biggest difference as far as my trading, is just consistently looking for opportunities. So anyway, as we mentioned at the beginning of this, we just wanted to encourage you guys to get trading. You guys have the software, so you should be using the software. You have an amazing tool at your disposal to be making money, every month. And again, it's not that you won't have maybe a losing month every now and then, but with the stuff that we teach, you shouldn't have a losing month that often. And again, diversifying different trading methods, not only trading one type of method, using spreads to really reduce your risk. There's really no reason why you can't be profitable most months. So obviously, as you guys saw in our email, we have a special going on up until the Super Bowl, which we weren't even sure. I don't watch much football.
Well, the Super Bowl is for winners, and that's what we have. I mean, this webinar is only going out to Best Choice owners. Everybody that's listening right now is an owner of Best Choice software, and you should be using it. It is the most fantastic tool. If we could have built it better, we would have, but it is an incredible tool. So we're giving you I mean, this is the offer for the evening here. We're giving you a special. We've never done this before on data. It's our Super Bowl special. This is the best time of the year to be trading. You should be in the markets. We told you we're going to give you 10 trades this next month of February, and I'll give you the very first one. What do we have coming up next month? What holiday is it? Valentine's Day. What have we always talked about in February? Hershey's chocolates. I mean, our day traders, that was the very first trade that Hugh took, and he made, I think, what was it, close to $1 million in his trading?
Incredible.
He had, I know it was, he made $250,000 in his first two trades with Best Choice software. Now, he's leading our day trading group. We're not going to talk about that tonight, but if you're interested in day trading, we have that as well.
You want me to pull up Hershey's real quick?
We will do that, but we just continue. Okay. We got a couple other things. We got Gary's webinar. We have our newsletter, which we have fantastic educational stuff. I mean, if you're not taking advantage of all these opportunities we present to you, you're missing the boat. And of course, by missing the boat, we have the cruise. And if you're not on the cruise, you're missing the boat. Right?
That's pretty deep too, Pete. Obviously, tonight is Friday, and there's nobody to help you tonight. But call the office Monday morning. Kathy will be here to help you with anything you need. Gary's weekly webinar is on Mondays at 4 p.m.
I think Linda's going to be here Monday night, but I'm not sure.
Somebody will be here for sure. Right. So highly recommend Gary's weekly webinar. He gives out some great trades, some great training every week. You can ask him any questions that you want, and we highly recommend that as well. And so, not last but not least, or something along those lines. Well, the final slide. You ready for the final slide?
Well, no, we're going to answer a few questions for everybody.
Let's do that first before the final slide. That's it.
Okay, let's have some more questions.
All right, let's do that, because I'm sure we probably missed a lot. So we've given a lot of information, so we probably can expect a lot of questions. Let's see here. Let's pull this out.
Oh my God! When your scroll bar is really tiny, that means you've got a lot of questions.
The scroll box, yeah. All right. Do you want to say anything while I'm just going through here real quick? Do you want to mention anything else? I should have probably been doing this while you were talking about the cruise. Let's see. Okay. Michael asks, is price consistency and earnings searchable in Wizard? Yes. Everything we talked about tonight is in your Wizards, and it's searchable there. Absolutely. When is our next cruise? It's May 28th. It's coming up quickly. In fact, you guys, if you are interested, even remotely interested in the cruise, you have to call us here this week, because I know I'm actually surprised that we're even able to continue accepting people for the cruise.
Now, I'll answer a question. I'll let you look at a couple others.
Okay,
here.
Go ahead.
We had a question coming up. How many contracts do you need to do in a calendar spread? You can do it with buying one long and selling one short. That's as little as you can do. And in that example I gave you, the $5 call was costing you times 100 is $500, but you're getting $200 back. So the spread's costing you $300. So that's on that particular high-priced stock. So I mean, you can find other stocks where the spreads are a lot less.
Yep. Okay, a couple of things here real quick. Michael mentioned good option examples, but all Greek to me. If you're not familiar with options examples, there's multiple ways you can learn. We obviously recommend Gary. He teaches options and goes over options examples each week. Also, somebody had mentioned here about getting option prices from a database. We don't get option prices from a database. We download them from a service. And if you're getting an error, you may not have the most recent executable or version of our software, and I would recommend calling Fred, who is our tech support guy. You can find his information on how to call him on our website by going to the Contact Us page, and you can find his email or his phone number there, because it sounds like you may not have the most recent version of the software. Another person here, can you comment further on the divergence between price and earnings on LMT? Let me pull that up here real quick, because that's a good question here. And let's do LMT. And let's pull up a little bit longer time frame so you can see that divergence. Okay, so yes, the earnings growth on LMT is not growing as fast as the stock is rising. I've talked to Pete about this a few times in the last year because this, to me, is a little misleading as far as if you think, oh my gosh, this price is up here, it can't go up much higher because it's getting so far away from earnings. But really, to me, if you look at the PE ratio, if the PE ratio is low, okay, that still means that the stock price is fairly low versus the earnings, okay? And I wish I had a better example because I'd love to show you a better example of this. Oh, gosh, I know there's stocks out there. Let me just look real quick. Okay, this is a great example, Netflix. All right, Netflix is not a good buy and hold stock. Even though the earnings have been going gangbusters, look at the PE ratio, 110. All right, let me show you the example here. This is going to be a good example for you to understand better what this number means. Netflix is a $400 stock, and yet right now their quarterly earnings are only making $4 a share, not even quite $4 a share. So remember that, $400 a stock. Actually, you can see here, the earnings are about 1% of the price of the stock. $400 stock, almost a $4 earnings per share on their last quarterly earnings. Actually, I don't think we even have their last, this is the second to last quarterly earnings that came out. We don't have the current one quite yet because our service hasn't issued it yet. But anyway, 4%, okay, or I'm sorry, 1%, okay, $400 stock versus almost a $4 current earnings quarter. Let me go back to LMT.
But people love Netflix.
So people love Netflix. But look, all right, this is a $200 stock. Whoops, let me go back here. Stock price right now is $200, but the earnings quarter is $10, okay? This is a 5%. Their earnings, current earnings is 5% of the stock price versus Netflix, which is only 1%. That is where I'm talking about this PE ratio. The lower this number, the more the company is making money versus the stock price. So LMT is a much better value at this price versus how much the company is making versus Netflix. Okay, so even though the growth isn't growing as fast, this line really here should be up here. And this is what I've talked to Pete about before, to making it maybe a little bit more real, I guess maybe would be, where these earnings are coming into the current price from over here, so it doesn't make it seem like, well, the earnings aren't moving as much as the price. Yes, that's true. Technically, the earnings are not moving as much as the price, but the price of the stock is still low versus how much the company is making versus other stocks. And this wasn't one nice thing about the PE ratio. You know, Pete was talking earlier about the annualization that we have on the options. That's what this PE ratio does for stocks versus their earnings. It allows you to compare apples to apples, where you can see the difference on the price, the value of the stock versus the earnings across any stock because you can compare their PE ratio. So I hope this helps answer your question as far as this divergence. Yes, technically there's a divergence, but the stock price is still very low versus how much the company is making and still has plenty of room to the upside for growth. So I hope that helps as far as answer that question.
Okay, maybe one or two more. We had a big crowd here tonight and lots of questions. So
well, I'm hardcore. If you want to go home, I'll stay for a little while and I'll answer some questions. But as long as people are wanting to stick around, you know, I don't have a problem sticking around for a little bit more. Thank you, Michael, for the mention as far as super for more webinars. Absolutely. Let's look through here and see if I got a few more questions here. A lot of these are just mostly comments, it looks like, and great comments. But we mainly just wanted to answer questions, some specific questions for you guys, so we can help you guys with your questions.
And it is being recorded. I see that a lot of people are asking that.
Right. Michael, you mentioned, or asked, what search parameters are you using to find great growth stocks? We did mention those, and with time, I don't want to go back. But when you get the recording, you'll go back through and watch that again, and you'll see that we do list the specific criteria. And if you have any further questions, you can always call the office here. And like I mentioned, Gary is a great person to get involved with for a lot of these questions also. Again, we got some more comments through here, just trying to find Another question about when the next cruise. Again, next cruise you can see there is coming up fast. If you guys want to go on the cruise, it's a great cruise. We 3 full days of training. We do seminars for 3 full days. You guys can ask any question you want, and it's on an amazing ship. I highly, highly, highly recommend these cruises because they are a lot of fun and you can learn a lot.
Our first cruise, Bret, we had the Netflix trade that just came out. This was about 4 or 5 years ago.
Netflix
oh my
trade.
God.
Is that a good trade?
Yeah, that was the one we just took. Same thing, 4 years ago.
Still
working. My God, everybody on that cruise ship was.
There's a lot of people that said they paid for their cruise 10 times over on that trade.
Yeah, that was it. That was a killer cruise.
Actually, I think I might be still in the middle of some of the previous ones that we went through.
Oh
here.
Wow, this is so. You guys have had we got tremendous number of questions here tonight.
Yep.
Unbelievable.
Joe asked, how do you screen for these stocks? We have search wizards built into the program. If you're not familiar with those, Joe, I don't know if you're an owner. You should be an owner, and if you are an owner, you should know, how to screen for these stocks. We have our wizards that allow you to search for specific criteria to find everything that we talked about this evening. So if you're not sure, how to do that, sign up with Gary's group and get those questions into them because they're more than willing to help you. And again, we do have those videos too that you can get. They're built into the software. If I go open up the software and go to View Online Videos, right there we got all kinds of videos built into the software that you can go and watch. And we show you guys. Here's our wizards. This is our main search wizard right here. And you can see we have all these search criteria that you can use these to find exactly what we showed you guys tonight. I'm not going to take time to do that tonight, but these are showing you how to do this is in the videos. Trying to continue through some of these.
All right, let's go to the last slide, and then we'll come back to more questions if people want to stay on board.
Right. Stuart asked, why scale in dollars and not in percentage? Mainly because that's just, that's a good question. I'm not sure if I can even answer that question tonight. We'd have to almost kind of think whether doing it in a percentage scale would be better than dollars, but as of right now, we just feel like dollars is a better scale to use, for comparing the earnings and the stock. Go ahead, sorry.
The earnings and the stock scales are scaled proportionally so that they are equal. That's the purpose of logarithms.
Mm-hmm.
Logarithms, on a scale, a logarithm, if you go from $1 to $10, the scaling would be exactly the same as going from $100 to $1,000.
Right.
Because it's a 10 times multiplication. So when we do scale these on the log scale, that's why we scale them on logs.
Yep.
For that reason.
Mark mentioned that, this was a comment, but I just wanted to, mention it. He hasn't been using the software because he's just really not sure how. So this webinar tonight has helped a lot, and this is exactly why we're doing it, so that you guys can, this is a great time for trading during the year, and so we want to, give you guys the education you need to be using the software so you guys can be making money also.
I like Jimmy Mack's comment there in big bold letters. He says, "Please send me a copy of this webinar."
Right.
Man, we're happy to hear that you guys are enjoying this evening.
Rocco said my data needs to be renewed in April. Can I lock in the data now for April? Yes, you can. You can go ahead if you want to get the savings now and then extend it till April of 2016. You can absolutely do that. Just call the office on Monday morning, and we'll be able, or the girls here at the office will be able to help you with that. Let's see here. Getting towards the end here, it looks like there's a lot of mostly more comments than questions, which hopefully we've given you guys enough good information that there hasn't been a whole lot of questions. Again, yes, this will be recorded. We'll be sending you guys the link here as soon as we can get it up online and available for you guys. Nestle asked, how can I access Gary's weekly webinar? It's $100 a month. Give us a call on Monday, and the girls can help you get signed up for that so you can catch it on Monday afternoon on the first day at 4 o'clock. Brian mentioned Option Industry Council website is very good for beginners. Yes, there's a lot of good information. Just search in Google. You can Google vertical spreads and learn a lot on your own online. There's a lot of good resources for learning how to all the different ins and outs of trading the different option strategies and even straight calls and puts. So one of my favorite sayings is Google is your friend, and so it's a great way for learning all kinds of stuff, not just options. Ghana mentioned Pete used to show GE with divergence as reason for the fall, and obviously all of us continue to learn and get new ideas and try and get better at showing the software and trying to figure out what is the truth when we're looking at stocks and the different charts and that kind of thing. So that's just one of the things that we've kind of realized here in the last year or two, is to combine using the PE ratios along with the earnings and price to get a better picture overall of what we can expect going forward. Michael said also, give us the search criteria. Again, we did mention that the search criteria that we mentioned is what we pretty much all of us use for those longer term searches and the high consistency searches. So we're not going to mention Hershey tonight. I would imagine Hershey is going to be talked about by Gary coming up here pretty soon, because that is a major trade for Best Choice. So unfortunately, we just don't have time to talk about everything coming up. Ross said, please repeat the 3 methods of using Best Choice for trades. The first method is a seasonal, these are not in order as far as best to worst or anything like that, but the seasonal trade is one method. We have the high consistency price, or the high price consistency, where we're focusing more on the price consistency for shorter term trades like 2 to 3 months. We still want some decent earnings, but the earnings don't have to be running along right with the price growth. And then the third method is the longer term, where we are focusing on more on the earnings. We want to see the earnings at least with a good PE ratio, but also with good price growth also, that are a little bit more longer term trades, 6 months to a year, where we're holding for a longer term and then there's selling short term against it. So those are the 3 different types of main methods.
Let's wrap it up here, Brett. We can still answer more quesys, but let's get to that final slide.
Yeah. All right, just let me do the last couple.
You guys jammed us with questions tonight.
Yep.
Unbelievable.
Yep. Again, Michael, tonight was not supposed to be a training webinar. We just mainly wanted to show you guys what's been going on with us, the trades that we're looking at, the trades that we've been making ourselves. A lot of you guys I think may not have realized that we had more than just one trading method with the seasonals. And so, we just want to do some education tonight as far as things that you can be doing in Best Choice right now to be making money. We are going to schedule some more webinars coming up in the future, for more specifics. Again, we can't emphasize enough that Gary does a great job every week, also giving more advanced training. And so, unfortunately, like I said, it's almost 20 to 10, and so we just really want to try and keep this, to at least not, too much of an extreme as far as time. So it looks like that's most of the questions. Again, we appreciate all the comments. We're going to go back over all the comments again after the webinar tonight to see how we can improve the webinars. But Pete did say, let's get this last slide up here. So I think Pete wants to get home to his wife, and I don't blame him. So, all right, here's the symbols that we talked about.
Here's what you guys been waiting for.
So here's the first lineup here is 10 100% stocks, the stocks that have gone up 100% in February. These are the seasonal stocks that we mentioned in the email. These first ones here are the ones that go up in February, and then we have a couple also that go down in February. So this is, and go ahead and write these down. That's why we saved this slide to be the last slide, so you guys, we didn't have to wait for you guys in the middle of the webinar to write these down. Here's some great high earnings growth stocks, and this is actually kind of opposite the way we presented. We presented the high consistency stocks first, and then we talked finally about the high earnings growth stocks. These are the little bit longer term stocks, looking to buy some options, some call options out 6 months to a year, and then sell premium against it, when on pullbacks. And then you've got these high consistency, slightly shorter term trades that last 2 to 3 months. Sometimes you can still sell some weekly options against these ones also. But go ahead and write these down. Take a look at them throughout the week. Look at them in Best Choice. Get in your mind, what these charts look like. These high, yellow bands, very tight yellow bands that are moving, up to the upside. Very, low volatility stocks that, are great. Probably the best stocks you're going to find out there as far as trading stocks. And so, hopefully, like I said, this helps you guys. We want to help you guys. We want to help you guys make money, and let's make money together. We got a great tool. We all have access to the same tool. Let's make some money. So, All right, I'm going to take one last look just to see if there's any last questions.
Guys, while Bret's looking at the questions, we had a blast tonight giving you this seminar. We certainly appreciate all the questions and comments. I mean, this is overwhelming what we're seeing tonight. This is an incredible software. We're glad that you guys appreciate it and are making money with these things. I mean, when Christopher Cross years ago told me he went from 6,500 to 1.6 million. I mean, that's almost hard. I had no other software in the world that I know of have ever heard anything like that. And one time when another one of our customers came and told me he had 23 triples out of 25 trades, and he drove 7 hours across the Rocky Mountains in the middle of winter just to come to my seminar. I couldn't believe it, you know, how dedicated some people are to this stuff. But the more you learn, I mean, there may have been some things tonight that went over your head. Learning is a process. It takes time. Look at charts like Bret said. We learn. We're always learning. As a matter of fact, 10 years ago when Bret and I built the seasonal stuff and we showed it for the first time, I didn't even know what I was looking at. But now we look at these things and we're experts. The more we did it, the better we got.
And we've even had users that have given us suggestions that we never even thought about either on the different trading methods. So,
well, now we're letting you copy these symbols down, but one thing that's also starting next month that I want you to be aware of, you know, we've seen this huge drop in oil. And, of course, the Saudis have been just pumping oil like crazy, trying to our fracking is what's hurting them, and they're trying to have big competition to wipe out some of the production in the United States, as well as hurt some of the other Arab countries and the Russians. So they're going nuts dropping this price of oil. But typically in February is when the oil prices start turning around. So that might be something to kind of keep an eye on. Because usually they go up from February through about May. That's a seasonal pattern that you should be aware of.
You actually mentioned something that's really important too. We've been talking a lot about airlines tonight, you know, Delta and Southwest, and there's a stock, EOG, that also is showing great earnings growth, okay? You can see here we're below the bands, but EOG is an oil stock, okay? So it did get hammered quite a bit by oil prices falling. And so you might want to consider, and this is, I mean, nobody knows the future. So oil prices, a lot of people are saying oil prices are not going up anytime soon. Some people are saying, you know, we're going to head right straight back up. There's no way to know. Nobody knows the future, obviously. All you can do is try and trade with what the stock and what everything is actually doing, okay? But if oil does stay low for the next year or so, is that going to help or hurt a stock like EOG? Obviously, it's going to hurt a stock like EOG. And so, you know, I'm not interested in trading and holding a long-term stock or a position on a stock like this. I think that oil won't necessarily just go straight up, and EOG could experience some bad earnings quarters. Versus a stock like Southwest, do you want to be in a stock that's going to be hurt by low oil prices, or do you want to be in a stock that's helped by low oil prices? Obviously, the airlines are being helped by low oil prices. So these are going to be much better stocks going forward to be in versus oil stocks, at least in my opinion. Now, of course, if you think oil is going to start going back up, or even if you don't want to guess, just watch oil futures prices, and if they start going back up, you know, pretty quickly, then that will probably hurt stocks like Southwest Airlines, and that will probably help oil stocks. So there are some good fundamental things to look for also when it comes to these types of things as well. There was a couple other questions here real quick that came in.
Bret, what I just noticed on this chart, where is Hershey's?
Is Hershey's 100%? Is Hershey's 100%? But no, you know, it's not 8% though. It's not 8% move.
Did we have a move that it didn't happen one year? HSY?
I don't know. Let's find out. You know, we have this amazing software called Best Choice. We can find out. Do I still have, yes, beta is spreading a whole zone in February, right? So we highlight it and, Looks like we've had a few years that.
Well, you got 12 out of 14. That's close enough.
Hey, if anybody wants to really be mad about an 85% win rate, maybe you're just
winning 85% of the time. Are you unhappy?
Maybe you're just a better trader than we are.
Well,
if you're actually getting 100% of your trades.
All right. Well, that's not 100%er. So
it's not 100%er. That's not why it's in the list.
It didn't make the list.
So
this is what you run into. Sometimes, hey, 85% is not bad.
Yep. There was one thing here that somebody had mentioned that I thought was a really good thing to bring up, and now I've lost it. If you'll give me just a couple seconds here. Someone said, could I comment further on how I set stops if time permits? As Pete will tell you, I've struggled, in getting on with the longer-term bandwagon because it's just like watching paint dry for me. And I've always been a shorter-term trader. But when I keep seeing these stocks every year making all this money, and short-term trading is hard. I mean, trying to time down to the day, stocks are bouncing around. Short-term trading is hard, so I've kind of been moving more towards some longer-term type trades and gotten away a little bit more from the shorter-term trades. But I still like that 2-day breakout I mentioned, where I want to see a close above the last couple of days, and then I use a 2-day trailing stop, where if the stock does close below the low of the last couple of days, then now that's one thing I do like about these longer-term trades, because I don't have to get stopped out. I'll just sell some premium. And so sometimes, 5 days later, the stock may break out again to the upside. So, okay, I'll take off the short, and I'll just let the long one run. I don't make money on every trade. Some of my short-term short calls, I'll lose a little bit of money on those, but I'll make up for it on the long calls, because if I'm losing on the short call, that means the stock's going up. And that means I'm making money on the long call. So over the longer term, I'm still making money overall, and that's the main thing. So let's see here. Let me just.
I'd like to bring up one point too.
No, you gotta go home. You didn't want to stay here, so you gotta go home. You're done. Go ahead.
We have the day traders, and people say, well, what's the difference between the way we trade and the way they trade? Well, first of all, there's different tools for different time frames. Certainly they wouldn't necessarily be using the seasonality. They're looking at a much shorter time frame, so they have to have more precise. They're more technically oriented as far as what they're doing, as opposed to the tools that we have are pretty much a lot of tools that we built that we found very effective for the time frame that we're using. So you can learn from both. I mean, that's why hey, learn it all. Be as educated as you possibly can be, because you're going to make more money. That's what professionals do. And the more you learn, the better you become at this profession.
Absolutely. If we did miss any of your questions tonight, we apologize. There was so many comments also being made that it's hard to find the questions inside the comments. And I know there's a couple of things I saw that I tried to remember, and then now I've forgotten them. Again, we're gonna. Somebody said, how are you gonna get access to the webinar? We're gonna send you guys an email link here in the next couple of days. Well, probably towards the first few days of next week, because it's the weekend already. So you will be getting an email from us with the link to be able to go back and watch the webinar. Again, I apologize if we did miss any of your questions, but it is getting really. It's almost 10 o'clock now. I could go for another couple hours. I don't know about Pete, but I mean, that would be obviously unfair. So again, thank you guys so much for being here tonight. Again, we just want to be here for you guys and be able to help you guys any way we can with the software. I guess with that.
Yeah, we thoroughly enjoyed it, and with that, I guess it's about time to say goodnight.
Party on, Pete.
Okay, let's do it.
All right, have a good night, guys.